Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Takuri candle pattern. The Takuri candlestick pattern, a frequently misunderstood signal that can improve your trading approach. By the end of this video, you would understand exactly how to identify a genuine Takuri pattern. So stay with me until the end of this video, as we will not only break down how to identify the Takuri pattern, but also reveal how you can use it effectively to improve your trading exit and entry points. Now we start by understanding what Takuri candlestick pattern is, and the Takuri line is a single candlestick pattern that forms during a downtrend. It is characterized by a small body at the top of a candle with little to no upper shadow, and most importantly, an exceptionally long lower shadow that extends downward. This low shadow typically measures at least 3 times the length of the body, showing a significant price rejection from the lower levels. The name Takuri comes from the traditional Japanese fishing technique, where fishermen would use long lines to catch fish near the bottom of the sea. This perfectly illustrates the pattern represents in the market, a probe of low prices that ultimately gets rejected. So this is exactly what we are talking about, the Takuri candlestick pattern. What makes the Takuri pattern significant is its location, what it tells you about the market sentiment. When you spot this pattern forming during an uptrend or a downtrend, it indicates that sellers are pushing price specifically low during this section. So when we see this pattern form during a downtrend, it indicates that sellers push price significantly low during the trading section, but buyers stepped in with enough strength to push price back near the opening level. It is important that you do not confuse the Takuri with similar patterns like the hammer and the dragonfly, which they share similarities. The Takuri specifically has a very small body at the top with extremely long lower shadow. So the Takuri has a small body with extremely long shadow, while the hammer has a slightly larger body, while the dragonfly doji has virtually no body at all. So these are the difference between these candlestick patterns. When you correctly identify a Takuri pattern in your chart, you are spotting a moment where market sentiment might be shifting. However, as you would learn later in this video, how you should trade this pattern might surprise you. How do we trade the Takuri candlestick pattern? Now let's focus on how we can actually trade the Takuri pattern effectively. I will share two distinct approaches: the bearish continuation strategy and the traditional bullish reversal strategy. Let's start by understanding the bearish continuation setup, which might surprise many of you who thought that this Takuri is purely a bullish reversal signal. When you identify the Takuri pattern during a downtrend, let me get an example and show you what I mean. When we identify this pattern during a downtrend, immediately, instead of looking immediately for a reversal, you have to consider that this might simply be a temporary pause in the overall bearish movement. Here is how to execute this strategy. First of all, you wait for the Takuri pattern to fully form, then you place your sell order when price moves below the closing price of the Takuri candlestick pattern. You set your entry the moment price moves below the Takuri candlestick pattern at this area. This is where you set your entry. We need to confirm that there is a brief buying pressure that was immediately temporary, that was indeed temporary. We have to set our stop loss just above the high. Remember, this Takuri pattern, while trading a continuation, signifies a pause in price in the market before it continues in the bearish direction. So once we have confirmed that there was a brief buying pressure, which we can see here, there was a brief buying pressure, we'll take our trade once it closed below the Takuri pattern. We set our stop loss just above the high of the Takuri candlestick to protect our position in the market in case the market reverse or not. We have to take profits by aiming for at least 1:2 or 1:3, as the case may be. This is how we take profit. Now for those of you who still prefer to trade the Takuri as a bullish reversal signal, so let's see how we can trade the Takuri as a bullish reversal signal. We enter a long position. First of all, do not enter immediately after seeing this pattern. You have to wait for confirmations from subsequent bullish price action, such as a strong green candle following after the Takuri pattern, as we can see here and as we can see here. After the Takuri pattern, you wait and you see if you can see a strong bullish candlestick pattern closing after that. You enter your long position once price break above the high of the Takuri pattern. So you enter once price break above the high. This is the area where you enter after price breaks the high of the Takuri pattern. We place our stop loss just below the tip of the low. For a reversal confirmation, we just place our stop loss just below the tip of the low. This level represents the point where buyers step in, so that if price fall below it, your bullish hypothesis is invalid. This is where you take in this first scenario. We can also take in this area of the market once price has closed above the Takuri candlestick pattern. We place our stop loss just below the candle. For take profits, you can consider using average true range. You can use that indicator to set realistic profit objective based on the current market volatility. Or you can make use of your 1:3 risk to reward ratio. Whatever approach you choose to make, remember that position sizing is crucial. Never risk more than 1 to 2% of your trading capital on a single trade. You'd have to, regardless of how confident you feel in the trade, you have to confirm that your indicator is aligned with your candlestick pattern or other confluences, like trading this pattern in a confirmed support or resistance region can give you more confidence in taking this pattern. So we have to confirm, regardless of how confident we feel in this pattern, we should always risk a little portion of our account, which is at least 1 or 2% of our trading capital per trade. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, Do not forget to like, subscribe and turn on the notification bell so you would never miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.